using them for a car, for going to school, or for any other big expenses in your life, loans are available for you to use so that you don't have to save up and buy out of pocket. But have you ever wondered how loans really work? Let's take a deeper dive at different kinds of loans, as well as some smart tips so they don't end up costing you in the end. Let's start by answering the question, what is a loan? Simply put, it's money you borrow that you promise to pay back. Here are the main components of a loan. There's the principal, the amount you are borrowing. There's the interest, what the lender charges you for using their money. They can be fixed, which means the rate stays the same, or variable, meaning that the rate will change over time. And the term, how long the lender gives you to pay the money back. There are many different types of loans out there, so let's go over some of the most common ones. Auto loans are ones you use to buy a vehicle. The vehicle acts as collateral, or the asset used to secure the loan. Can't pay the loan back? The lender can take your car. Personal loans are unsecured loans, meaning no collateral is used. These types of loans can be used for just about anything, like debt consolidation, covering large expenses, or even an emergency. Student loans are used to pay for expenses to continue your education beyond high school. We'll dive more into those in another video. A mortgage is how most people pay for their home, with the house being collateral. The term is usually between 15 to 30 years. A line of credit is a flexible loan, where you borrow money, pay it back, and are able to borrow the money again. The most common example of this kind of loan is a credit card. When comparing loans, here's what to look at and what really matters. The interest rate versus the APR. The interest rate is what the lender charges, while the APR is the interest plus any fees. In other words, the true cost of borrowing that money. Know your credit score, as this will affect the interest rate you'll be charged. Know how long the term loan is. The longer the term, the lower your monthly payment will be, but you'll be paying more interest overall. Shop around for the best terms and best monthly fees. Speaking of the monthly payment, make sure that it fits into your budget and that you can afford it. And always ask yourself what this loan will cost you in the end in terms of fees. Always be sure to read the fine print. You may come across a certain loan called a payday loan. This is a short-term loan where you borrow a few $100s that is meant to be repaid by your next payday. Sounds helpful, right? But these loans come with fees and interest equating to an APR of 300% or more. And if you can't repay the full loan by your next payday, the lender will roll the loan over and add on even more fees, making it even more difficult to pay back. Within a few weeks, you'll be trapped in so much debt, it will seem impossible to get out of it. A payday loan is known as a predatory loan, and it's not the only one that you'll find. Here are some things to look out for in order to avoid them. Any loans that say there's no credit check needed. Loans that have terms that are especially short, like a couple of weeks. Loans that have extremely high fees and interest rates, making the APR 100% or more. The lender pressuring you to sign now and skip reading the contract, and the contract even having no clear explanation of the loan's true cost. We all need help covering the big expenses in life, so loans can be helpful, but only if you understand the true cost, ask questions before you commit, and borrow with a plan. Thank you for joining us as we look into loans and understanding them a bit better. If you enjoyed this video, be sure to like, comment, and share with your friends. Also, subscribe to our channel for more financial literacy videos from Regional Federal Credit Union.